Let's get started, everyone. Thank you so much for joining us today, and a very very warm, heartfelt welcome to each of you. It's so wonderful to see so many dedicated individuals eager to transform their business through smarter tax strategies. And your presence here speaks volumes about your commitment to growth and excellence. So let's embark on this empowering journey together on how to unlock new tax possibilities and ventures. Let me start sharing my screen and let's go from there. Let me know in chat if you can hear me well and see my screen well as well. Let's just give 1 or 2 seconds. Taruna, can you see my screen properly?
Yes, I can see it very well. Hello, everybody.
Perfect.
Thanks for joining.
So let's get started. Hello, Michelle. So good to see you. So let's take on the agenda. We have a jam-packed agenda for today. I will go over a warm introduction. I will also go over professional services, identifying what really type of businesses these are, and strategies for high W-2 earners, as well as strategies for self-employed, workforce strategies for tax planning and tax opportunities. At the same time, advanced strategies and the qualified business income deductions and next steps. Give me just 1 more second. I need to change some settings on my end, and then I will be right back on this. Okay, perfect. Let's just get going. So my name is Minal Babaria. I'm a certified public accountant, as well as certified tax strategist, certified tax planner, as well as certified concierge accountant. And a little bit of a disclaimer, the materials in this presentation has been prepared by and is the property of KB Tax Divisor CPAs. Neither the presenter nor the presentation create an accountant-client relationship. All content, including images and impressions, are protected under U.S. intellectual property and trademark laws. Any reproduction or dissemination of any element of this presentation without prior written consent from us is expressly prohibited. So before taking any action, based on this information, we strongly encourage you to consult with professional accounting advisor about your specific situation. A little bit about who we are. We are a family-owned, award-winning, leading tax strategist. As you can see in the picture, it's myself and my sister, Taruna Kanani. We both are CPAs and we both are sisters. Our mission is transforming lives, one taxpayer, one family at a time, utilizing holistic approach to integrate personal and professional financial goals together for our clients with proactive, customized tax strategies and financial guidance to minimize their taxes and to maximize their wealth. Empowering you to live fruitful lives, make your money work for you rather than you working for money, and help families leave a lasting legacy. We are serving clients throughout the USA, and I'm proud to say that we have been proud winner of Reader Ranking Award for 2 years in a row in Lehigh Valley as one of the best accounting firm. So without further delay, let's dive in a little bit about myself. I have over 2 decades of tax industry experience. As you know, there are millions of accountants in USA. However, only about 41 of us are licensed as a certified tax strategist. And as a certified tax strategist, I'm extensively trained in identifying deductions, loopholes, credits that save my clients thousands of dollars in taxes every year. On the other side, I do mentor other accountants and accounting firm with tax planning for their clients, their businesses, as well as business growth services. And I myself am a huge real estate investor. I own more than 800 doors on multifamily units, storage units, and rentals. Winner of 40 under 40 by CPA Practice Advisor Award, and winner of Gold Stevie Award for Women in Business in accounting and finance category. So I myself am a huge investor, and I do understand the power and value of money and how it really synergizes and works together with the taxes, wealth creation, and investment, and all of that combined together as well. So if you don't have pen and paper ready, get your pen and paper ready, because I'm going to go a little bit faster next few minutes. We only have less than 50 minutes remaining together. And I want to make sure this is a jam value packed session for my attendees. And we want to provide you tremendous amount of value in our time together. So looking at the tip of iceberg, this is what people think they can save in taxes. But in reality, when you dig deeper into the tax codes, this is how much you can save in taxes. You know, the Tax Cuts and Job Act is about 37,000 pages long, out of which only 30 pages tells you how to prepare your taxes by putting in right numbers in right boxes and calling it a day. Rest 36,970 pages tells you have to not pay the taxes, which is what I and my team study heavily. So in the last few years, my clients have saved over $42 million in taxes just by working with us. And if it was not working with us, this money would have been donated to the IRS, just like many of you do. And by the time they retire, my clients will have saved over $79 million in taxes. And that's a lot of money. So let me take one of the case study of my client. Meet Courtney Kiel, owner of Expert Marketing Advisors. She was going through sleepless nights, haunted by threats of rising taxes and cost, smothered her dream for growth and expansion. She was frustrated by inability to expand, hire, raise wages in this competitive market due to unclear financial planning. Discussion with KB Tax team revealed critical flaws in her financial strategy, igniting urgent relief. And she soon realized that her outdated tax strategies were sabotaging her success, sparking a drive to reclaim on lost time and opportunities. And she sought out strategic relief by partnering with KB Tax Advisors to overhaul her tax planning. And what we did as a solution is a prior year amendment resulted in $64,000 tax refund. Custom tax plans saved additional $51,000 in taxes in year one and moving forward. That itself is more than $100,000 in tax savings right there. Newfound clarity led to many strategic decisions, some of which included tax-free benefits for her employees, and she raised wages for her employees as well. In marketing industry, most people have contractors. It is unusual for people like Courtney who believe in hiring employees more than the contractors. She retained 100% of her staff through the COVID years and added more new hires. Not just that, because of this money that was, saved on taxes, she invested back those money in her business, and she got 100% year-over-year revenue growth in 2021, 2022, and 2023. And she expanded by acquiring new agents in 2023 and she is preparing for another expansion literally next month. Not just that, just literally last week, she purchased a new home in Texas and she is moving out of California. So a lot of these things are possible when you're not operating your business out of stress and out of uncertainty, out of limited bandwidth, versus having that full mental clarity and, having certainty and confidence in making the decisions, having a goal plan where you want to go in your business, especially making your money work for you rather than donating this money to the IRS, right? Not just that, we also introduced KPI metrics to sharpen her business performance and decision making, and we guided her on disaster benefits and best practices. There's a saying, a lot can be done in within a year versus what can be done in 10 years. And, sometimes people just underestimate what can be done in a year, right? So Courtney is a perfect example of what is a possibility within a year. Now, here's her Google testimonial, which you can definitely see on our Google page as well. In comparison to other business advisory firms I have worked with, the quality and detail of service that KB Tax Advisors provide is unmatched. As an owner of a marketing agency, I wanted a firm that understands my core business, and I believe that I have found that in KB Tax Advisors CPAs. They offer ethical and knowledgeable advice to ensure money is invested back into my company's growth while offering forward-thinking tax strategies that looks out for the best interest of our company employees. From their full line of tax planning, accounting, and preparation services, we are very pleased with their level of service and responsiveness and can unreservedly recommend KB Tax Advisors CPAs for your consideration. I look forward to growing our business with them for years to come. While the strategies we will review today are very, very powerful, it's important to make sure you are qualified, you calculate numbers correctly, and you implement appropriately. So make sure you have something ready, pen and paper or your digital tablet, to write down some of these tax strategies as it applies to your situation. So let's dig into what it takes to realize these savings. Professional services tax planning opportunities. Now, let's first of all talk about how does the IRS define professional services? Typically, but not always, a professional will be a sophisticated, highly educated entrepreneurial client. You may be a doctor, dentist, lawyers, marketing agencies, finance professionals. You could be insurance agencies. You could also be a creative, such as traditional artists, textile producers, graphic design artists, or photographer. A lot of those fall under professional service providers. And who is best qualified for these strategies? Someone who is high income wage earner, someone who is a sole proprietor, established small business. It could be anyone with combined income of more than $400,000 from W-2, investment income like interest, dividend, capital gains, K1 from multiple business or investments, passive or non-passive, retirement income. So in short, anyone who is an accredited investor or anyone above $400,000 in income, qualifies for most of these strategies. If you're less than $400,000 in income, you may qualify for some of these strategies, but you may not get as high tax benefit as the people with the higher income, because they are in a higher tax bracket. So sole proprietors are individuals who are starting out, who are owner of a company. Often it's a one-man show, right? Reports business income on a Schedule C. They may or may not have employee. They may have a contractors, and maybe sometimes they're partnering with their spouses. I don't think I need to go into details of all of them. I think you all pretty much know who they could be. Established small businesses are the individuals who could own an LLC or a partnership or an S Corp. They could be reporting incomes on 1040, often receiving a K1, may take a salary or receive guaranteed payments. They often have a distribution. And if you are taking a salary or guaranteed payments and have distribution, it's extremely important that we maintain reasonable compensation requirement that is set by the IRS. So that if you are overpaying yourself in terms of salary, you are overpaying on payroll taxes or payroll overheads, which are unnecessary, right? And will have an ownership interest in the company. You could be a partner, real estate firm partner, partner in marketing firm. You could also be a real estate investor, passive investor, right? And if real estate investing is, of interest, I am more than happy to do a special webinar, especially for the real estate owners and investors. So keep on going. Let's talk about some workforce tax planning opportunities. These are many tax strategies that I will go over in next few slides, some of which may apply very well to your situation. So first of all, entity formation and optimization. This is one of the strategy which is often overlooked by owners when first starting out. And many just start off as a DBA or a sole proprietor or the same entity when they acquired business or family friend or on Google they research and they'll just start out. And it's just like, you're taking a prescription medicine of someone else and expecting to have the same results, which doesn't happen, right? So this entity formation has to be as personalized to your unique situation. So, we have three main options when it comes to the entity formation. One is disregarded entity, which is an LLC. It could be an S corporation or a partnership. And analyzing this at the formation of the company can save lots of headaches and money down the road. At the same time, I always recommend that you should be reanalyzing it every 3 years at least. Every 3 years, or at least, whenever you have a big milestone, jump in your business revenue, or you are expecting a big change, whether an exit strategy or whatever that is, it's extremely important to reassess your entity structure. Now, things that you should keep in mind to balance out to get the maximum benefit from your entity structure is your wages. Your wages as an owner of the company or guaranteed payments. Growth of the business, overall growth, is the business is at a profit, business is break even or a minimal profit. Overall payroll cost of the employees, how much is the cash flow? There is a profit, but you don't have much of a cash flow because your billing cycle is off. That is also important, to consider in entity formation, as well as your self-employment taxes. But either way, whenever you have a business and you're talking about an entity, you should be doing this business as an LLC, not as a DBA, because LLC is a first step. And then from there, various paths open up. Now, if it is an LLC and you're making less than $40,000 in net profit, I have done lots of side-by-side comparison, and in my experience, S corporation may not be as beneficial for you for an LLC or a sole proprietorship making less than $40,000 in net profit. Now, expense deductions. These are called some of the expense shifting strategies where you are going to have these expenses irrespective of the fact on the personal side. But now, because you have a business and we can establish a reasonable relationship between personal and business expenses, and if those expenses are considered reasonable and necessary for the operation of business, those expenses can be shifted from personal side to the business side. And that increases your tax deductions or tax deductible expenses on the business side, and hence it reduces your taxable profit. However, it's extremely important to keep in mind 2% shareholder rule applies to all of these expenses. The two biggest methods for the expense deduction could be an accountable plan or fringe benefit. Think of an accountable plan, it's a tax-free reimbursement. for business-related expenses as long as certain requirements are met. Now, accountable plan reimbursement, as the name says, it's a reimbursement, which means it's a tax deductible expense for your business. So your profit is reduced, but personally, because it's a reimbursement, it is a non-taxable income to you. Now, what it means, it's not going to be reported on your W-2. It's not going to be reported on your 1040. It's a completely tax-free income from business to you personally, but it is extremely important. It's an accountable plan, which means you have to have formal accountable plan on your, company letterhead. It's an agreement that you have to have, and you are following safe harbor rules on the accountable plan reimbursement. You cannot reimburse more than what is the actual necessary and reasonable expense. Because if you reimburse more, then you have to pay taxes on that. Now, business deducts expenses, and employee, you as an owner employee are not taxed on this reimbursement. Now, fringe benefits, it's a small thing to boost your employee morale as well. In our company, and many of my clients provide accountable plan reimbursement benefit to their employees. And which employee in US would not like tax-free compensation? Pretty much everyone, right? Because they are not paying taxes on this W-2. It's not reported on W-2. And you as an employer are paying lesser taxes because, we don't have to pay any taxes on that, but we get 100% tax deduction, and your employee is receiving 100% of this money in their hands, right? So it's a small gesture, and, it really helps and goes a long way in boosting employees' morale. Self-employed health insurance deduction. Again, this is one of the expense which is often overlooked deduction by many business owners. 25% of self-employed workers do not have some kind of health insurance, but you can deduct 100% of all your health insurance premium for yourself and your family under the age of 26. And you can also include the long-term healthcare insurance premium as a deduction on the business. You can claim if you are a solo or an LLC member or a partner, doesn't matter. And for this rule, you do not have to be providing health insurance benefits to your employees. You can still deduct for the owner of the business, even though you're not offering this benefit to the employees. However, if you are an S corporation, we have to follow separate special rules. And if these rules are not followed, then as more than 2% owner of the S corporation, this self-employed health insurance could be non-deductible. So it's extremely important we follow the special rules for the S corporation owners. Now, what is this 2% shareholder rule? IRS rules state that certain benefits that would be non-taxable to the employees, and in this case, owner employees, and should be included in their wages. A 2% shareholder is any person who owns or is deemed to own on any day of the taxable year more than 2% of the outstanding or voting stocks of the company. Wages become deductions to the S corporation, and it still reduces your net profit. However, on the other side, those wages are taxable income to the owner employee and are picked up on your 1040. So, wages is like, such a sensitive topic for an S corporation. I feel like I can do almost whole webinar just on the S corporation owner wages and distributions. There are a lot of intricacies that goes in there, and we can just do a whole webinar on the reasonable compensation itself. Let's go over some advanced tax planning opportunities. Hiring children in business, and I'm pretty sure you have heard about this so many times. And, you reach out to your accountant with some of these ideas, and your accountant turn you down. The only reason they turn you down because they don't know how to put it into action in an audit-ready documentation way. So it's extremely important. Knowing these tax strategies is not going to help you realize the tax savings. It's extremely important that you implement these tax strategies in an audit-ready documentation way. The children who are hired directly by a parent as a sole proprietor or a partnership of the parent company can be hired without self-employed tax withholding. So if it is a company that is 100% owned by parents or one of the parent, then they can hire their children and they do not have to pay Social Security and Medicare taxes on it. It's a win-win, and you are shifting some of your income from higher tax bracket to a lower tax bracket of a children. This tax strategy is more beneficial, for children under the age of 18. If your child is above the age of 18, it's still beneficial because your child is going to be in a lower tax bracket. It's just that you would have to withhold Social Security and Medicare taxes. If children is under 21, income is subject to Social Security and Medicare taxes, but it's not subject to federal unemployment taxes. Now, once you pay your child, don't let your child spend all of that money. Put that money into Roth IRA because you can only contribute to Roth IRA out of the earned income. And salary is considered as one of the earned income. And your children could be starting their retirement portfolio at a very young age rather than when they are at our age and they have a real retirement benefit, right? So it's a very, very strong and beautiful way to secure your children's future. Now, let's talk about family office management company. For families with an S corporation or a C corporation or a partnership with non-parent owners, this stacks with the hiring children strategy. Again, when we talk about strategies, we stack different tax strategies. LLCs formed and hired by the company to do outsourced work, such as it could be accounting work, marketing, clerical services, and company passes income through to family member and allows for hiring of children as well. So if you are someone who owns a part of a company with an outside partner who is not your spouse, in that case, family office management company could be a great way to hire your children as a separate company and carve out a contract between family office management company and your main company. Let me know if any one of you have any questions. I would be more than happy to kind of address those questions. Trina, I think we should launch a poll. I think you have prepared some poll questions for us.
Let's do our first polling question.
How are we doing so far on webinar content? So the first poll question, how confident are you in your current tax planning strategies? Very confident, somewhat confident, neutral, or not very confident, or not confident at all. While you all take the poll, let me go over self-employed retirement plans. At least 1 in 5 self-employed individuals do not save at all for retirement. And only 68% are saving for retirement on a consistent basis, and they are mostly putting in IRAs or Roth IRAs. So main options, we have options like solo 401k, simple IRA, or SEP IRAs. And you may also qualify businesses for certain credits if you are contributing to the retirement plan. Again, when we talk about retirement plan, we have to take into consideration what is going to be your out-of-pocket expenses and what is the resulting tax benefit that we are talking about. Because if you contribute way too much and you're only, I always tell my client, I always ask my clients, what is the end result you're trying to achieve? If your end result is to save money on taxes, but at the same time provide benefit to your employees and go for SEP, SEP IRA, your employees will be thrilled because you as an employer are contributing up to 25% to their, retirement plan. Employees doesn't have to do anything on their end. But if you're like, I want to save money on taxes, but at the same time, I want to increase my take home money, or I want to be able to invest in real estate properties, or, want to grow my business, then SAP IRA may not be the best option for you. We have other options that we should be talking about. And you may also qualify for businesses for certain credits. And we have much higher limits than a regular IRA on some of the retirement plans. You know, I see lots of misconceptions when we talk about retirement plan. People think, why would I put my money in retirement plan when I can invest in real estate properties and whatnot? You know, it's a great idea to put in retirement plan, at the same time reduce your money on taxes. I mean, if you donate money to the IRS in terms of tax payment, it's never coming back. But whatever money you put in your retirement plan, you can also buy real estate property through your retirement account itself, or you can get a loan from your retirement account, or you can liquidate your retirement portfolio and invest in real estate property. But at least it's your money, and your retirement plan will be considered as part of your, your net wealth. So if you're trying to achieve that accredited investor title, that qualifies you for that. However, paying higher taxes to the IRS does not give you accredited investor title, and you cannot borrow any loan from the IRS, right? If you need money, 2 years, 3 years down the road. And people don't realize how much money they are putting in taxes year after year after year. You have to look at cumulative tax payment versus 1 year as a standalone, right? So I think we have, people have responded to the poll. Let me know when you want to end the poll. Oops, I think
The poll is ended.
oops. Bear with me, guys. I think I went too fast on my mouse and I scrolled through multiple slides. So let me get back to the right slide. Okay, I think I got it. Thank you so much. So let's go over payroll credits next. Another tax strategy that is often overlooked is payroll tax credits. Generally any business that has payroll may qualify for some kind of a credit, but watch out if you are more than 2% of the owner of the company or shareholder rule. And some small businesses may qualify for small business health insurance premium credit, which sometimes businesses don't know, credit for paid family and medical leave, work opportunity credit, credit for employer provided child care facilities, and credit for set plan startup cost. And if you, if you are someone, you own a business and you have a spouse who has an outside job, when we work with you, I also take into consideration your spouse's employee benefit package from an outside employer, just to identify what are the tax-free benefit that your employer is providing, and how can you maximize your family's joint wealth and reduce your taxes overall. So next one is depreciation and expensing. It's an extremely low-hanging fruit, yet people miss out and don't claim all the time. Assets with a life of less than a year used in the business can be expensed in that same year itself. Most people take it as an expense sometimes, but they don't realize, booking it as an asset and writing it off as an accelerated depreciation in year one makes your balance sheet stronger and more appealing when you were to go and sell the business, or you were to go out and get any loans on the business. Assets with an expected life of more than a year can be depreciated. Bonus depreciation allows for 100% depreciation deduction in the year in which the asset was purchased. And this rule expired in 2023 and it went down to 80%. And then it will phase out completely by 2026. But I would not be surprised with the elections and everything coming if they extend it even further, because they keep saying it's supposed to expire. At least I have been hearing it for last decade. It hasn't expired. They always kind of, throw in something new for bonus depreciation or Section 179. The next one is QBI. qualified business income deduction. And this is one of the tax strategy I have seen often overlooked because it's very complicated to calculate QBI. And even if you did the right thing by setting up the S Corp, you may not be doing right thing with the salaries and wages for yourself and your team and the net profit and distribution ratios, and you could still cause issue with the QBI, and you will not get any QBI deduction on your personal tax return. So anyone who has any kind of pass-through income qualifies for qualified business income deduction. The pass-through income could be coming from an S Corp, it could be coming from your partnership, it could be coming from your Schedule C, it could be also coming very well from your real estate investments or your capital gains on the stocks and whatnot. Qualified business income is the net amount of qualified items of income, gains, deductions, or loss. If you had a loss in 1 year in business, that will impact your QBI deduction for that year and perhaps for the next few years until that loss is exhausted. Who qualifies for these strategies? There are multiple calculations to determine if you qualify and how much you can deduct. If you qualify first, you must have a pass-through income. If you're married filing jointly, your income must be below $340,000 for the full 20% deduction of business income. And if you are single or head of household or qualifying widow or widower, your income must be below $170,000. Now, if your income is above this limit, this slowly, it phases out. You get some small deduction, but you don't lose out completely. So it's very important, when you have an spouse who has an outside job, and together between that spouse's job, your profit in the business, and your salary, if your income hits above this threshold, we kind of do proper planning to make sure you get the maximum qualified business income deduction. And in our case, we do this planning on a quarterly basis and reassess. Just like you check your weight again and again and again in your weighing scale, so that you don't all of a sudden you don't add up 100 pounds, right? Until your clothes are not fitting you. It's important with the QBI, you reassess every quarter. Now, going on, if your income goes above the previous threshold, the QBI gets a little bit more complicated. And after the threshold, if you are in a specified service, trade, or business, there are a lot more limitations that come into play. So if you're above the top income thresholds in an SSTB or specified service, trade, or business, there is no deduction allowed. So there are phase out limits for that. If you're not in a specified trade or business, the people who would fall under specified trade or business would be insurance agents, financial advisors, accountants, where your intellectual is the main, source of revenue. And, it's based on specified services. Attorneys fall under that group as well. So qualified business income deduction calculation is far more complicated. So if you're not in SSTB, the QBI has two 20% calculation. First is regular 20% of your business net profit. The second is 20% of the lesser of 50% of company's W-2 wages, which includes shareholder wages as well as outside employee wages, 25% of company's W-2 wages plus 2.5% of the unadjusted basis of qualified property. The lesser of the two is your allowable QBI deduction. As I said, it's complicated. Even if you make a note of this, you will not get it because it's a little bit more complicated. And please don't take it personally. Many accountants don't get it. And I review so many tax returns on a daily basis. I find mistakes in pretty much all tax returns when it comes to QBI. So the major benefit includes certain things are added back or backed out to determine QBI. It helps you lower your adjusted gross income or your taxable income. So, if your business is making $100,000, say, for example, in revenue, you could easily be eligible to get a QBI deduction at $20,000 range or so. And this reduces your taxable income personally. Hence, your taxes are reduced. So Remember, this is just one category of tax planning. There are so many other tax strategies over and above what I shared earlier in my slide. And I always hear tax planning is complicated because I don't know how to accurately calculate this cost, or I don't know what does and doesn't qualify, or I don't understand which strategies I can or can't do together because you can't double dip on some of these tax strategies. And the biggest fear that most of the business owners have, what if I get it wrong? Am I going to go to jail? No, you're not going to go to jail. But if you're just doing, using ChatGPT or Google and implementing strategies based on haphazard knowledge, and if you get audited, you cannot tell auditor, I relied on Miss Google or I relied on ChatGPT. You will definitely get hit with extra tax liability on that side, right? So while these questions are completely valid for the new tax planners, you don't have to figure it out alone. The whole process that we have with my and Taruna's expertise and award-winning team is, we are doing this webinar today. And if any of those strategies or any of this resonated well with you, reach out to us, schedule a meeting with us. Within 48 hours, we will send you document request list. And if you were to come on board and work together, we will schedule up a kickoff call within day 5 to 7, and you will have very well PDF copy of the tax plan, which references to for every single tax strategies that we recommend to you. Will have a reference to the IRS tax section code or court cases, and it's all written and customized for you personally, how it applies to your personal situation, your professional situation, and your forward-looking goals within 3 to 5 weeks. And then follow-up calls as needed for implementing all of these tax strategies. The packages that we offer are tax planning and planning, implementation, preparation, as well as quarterly meetings. The tax plan for the current year, next year, and beyond, deduction review and strategy planning. There are more than 95 deduction strategies that I and my team have identified, thoroughly researched, and we are constantly researching on more and more different tax strategies. Legal entity optimization across LLC, S Corp, C Corp, partnership, including QBI deduction and a whole bunch of that. There are more than 36 different tax strategies we have identified under legal entity optimization. Retirement options and plan to hit an extra $1 million by retirement. And, I understand many of my clients have different things when it comes to retirement. Some prefer to invest in IRAs, retirement accounts, whereas some prefer to hold money in real estate properties, stocks, and equities as their retirement portfolio. And whatever your goal is, we have customized strategies that we can cater to, for you to achieve your goals as soon as possible. Insurance review to protect your assets and reduce your taxes. Tax cuts and Job Act, family, I think FFCRA, CARES Act, and ARP COVID relief bill review for liability minimization. Review Biden tax policy proposed pre-law changes and make recommendations as well. IRS and court case references to support our positions. Now, that's a tax plan. If your accountant is very good and you only need help with identifying the strategies, we recommend tax planning package for you. And you can take that PDF copy of the tax plan, either do it yourself or have your accountant do it. But you're like, my accountant doesn't know any of this, I need more help, then we have more services that we can offer you, which is tax advantaged wealth management review, core strategy implementation. In core strategy implementation, we give you tools and resources that we have developed internally and refined over the course of time, helping you implement a lot of this tax strategy in an audit-ready documentation way. We understand you are busy professionals and we all are short and running on time, right? So we have created tools that help you, implement this tax strategy while remaining compliant with the tax rules. Business tax return preparation, individual tax return preparation, and most importantly, quarterly estimated payments, quarterly core tax planning and implementation, and quarterly one-on-one review of your tax positions. On a quarterly basis, my team meets with you to review your financial statement, your P&L balance, P&L statement, your balance sheet, and also go over what changes are happening in your personal lifestyle, professional lifestyle, and how are we doing with your goals, and whatever shifting we need to do in tax strategies, we communicate and we document all of that. You receive a quarterly impact report every quarter, which is a PDF report that my team prepares. In that report, we write down issues that we have identified, actions that you need to take between now and the next meeting, and the taxes you have saved with our strategies, taxes you would have overpaid without any tax strategies, and kind of, our recommendation. So these are the plans that we offer. Now, the next steps, if you want a second opinion, are you maximizing all the tax deductions, credits, loopholes that are available to you in your business? For the attendees of this webinar, we are offering complimentary second opinion or second assessment, where I will personally meet with you and show you exactly how much you are overpaying in taxes, which specific strategies can apply to your specific situation, and what to do about tracking your R&D expenses or other strategies moving forward. Karuna, let's open up for a few questions. And, Stephanie, if you can drop in our Calendly link in chat, that would be helpful. We cannot hear you if you're bringing in any questions. You're muted.
Okay, here is our first question. Can tax planning help in succession planning and transferring wealth to my kids?
Oh, absolutely. Many of the tax strategies that we have thoroughly researched and identified, it helps you with legacy building. So some of this tax strategy will not only save you taxes at your level, but when you transfer this wealth to your children, they will get benefit of the same tax savings as you were getting. And it's you don't have to worry about probate and a lot of those things. Oh, Michelle, so good to see that. We would definitely love to help your, friends and family members. And we offer a very good referral bonus. If you know a business owner or an accredited investor who is making more than $400,000 in income, every client you refer and signs up with us, you will receive $1,000 commission, from us. So that's a great way for you to make some money as well. Taruna, let's go over other questions.
Yes, we have another question. One second. How do I handle tax for my freelance or gig work?
So, here's the first thing. I would recommend you, you set up an LLC. That's the first step to start. Now, if depending on your net gross revenue and net profit from the business, I will recommend whether an S corp or a partnership or just staying as an LLC. And a lot of it also depends on how do you want to spend this money. What do you plan to do with the net profits of the business? But the first step, set up an LLC and kind of go from there.
Okay. What happens from tax wise if I sell my rental property?
Can you repeat that last one?
What happens from tax wise, from tax point of view, if I sell my rental property?
Okay, so if you sell your rental property, let's take an example. You're selling your rental property for $300,000 and you bought this property for $200,000. we have to capture in your capital gain, right? Also, we have to add back whatever depreciation you took over the course of years, right? Based on that, your capital gain will be determined. You will pay taxes based on the capital gain, whether depending on your income from all the sources, you could be in a 15% capital gain tax bracket or 24% tax bracket. However, no matter what tax bracket you are in, we have tax strategies that can eliminate huge chunk of taxes on the capital gain as well. Stephanie, if you can do me a favor, I think Michelle has few referrals for us who are over $400,000 in net worth. Can you drop our referral link in the chat box for us? Darna, what are the questions we have?
We have next question is, how can I use tax strategies for my real estate investments?
So depending on real estate investment and where you are at, okay? So say, for example, you are someone who is just starting out and planning to buy residential rental properties. I would recommend customized tax strategies for your situation. Whereas someone who has a job and passively investing in real estate as an LP, or who wants to become a GP in multifamily units, I would cater different strategies for you at that level. And again, a lot of real estate tax strategy comes down to what type of a rental property it is. And number one, and number two, is it a short-term rental, long-term rental? And number three, what are the other sources of income you have from all the other sources where we can, eat up any of your real estate losses? So we kind of come up with the different tax strategies based on your real estate and what is your long-term vision. Taruna, any other questions we have?
We have one last question. Can I use tax planning if I have multiple sources of income like business, investment, and rental properties?
Absolutely. In fact, more varieties you have, more options we have on tax planning opportunity. We can certainly take a look at each of the businesses as well as all the other sources of income to maximize out of all of those opportunities, to save money on taxes. There are a lot more tax strategies available if you're a business owner versus you only have an interest income or things like that. But even if you have interest income, dividend income, or capital gain, or just a pension or retirement income, we do have different tax strategies that will be applicable in those situations as well. One of the things, just think about it. What would tax planning will allow you to do? It can allow you to save you 3 to 5x more in taxes in the current year than what you invest, and save you what you invest in this year, but you keep that savings every year. It can help you take advantage of lots of opportunities, right? It helps you protect your assets for you and your family. Set aside for taxes on a quarterly basis so you never get any surprise tax bill. And when we don't have tax stress, we can do a lot of things and perform better at all other areas of life. It helps you properly document your tax position so you're not worried, and set aside savings so that you can start to invest for your retirement, and set aside savings and to plan for recession impacts. I hear from so many people that interest rates are so high, I'm not investing in buying real estate properties and whatnot. It's all stories to an extent. Why? Because people are putting away their dream to invest in real estate just because interest rates are high, but they're not doing any favor to themselves when they're overpaying and donating money in taxes. Instead, if you buy the real estate property even at an interest rate that are higher, you have built the equity in the property, but the money that you're overpaying in taxes to the IRS will never come back. It's gone. It's lost forever. Either way, I just thought, I would just throw in because I hear this from so many people, on the real estate side. But we have worked out different formulas, on the property, when to invest and what kind of formula to utilize based on the interest rate, and when to move forward with those real estate property, even in this economy versus not. But I really want to appreciate everyone. Thank you, everyone, for bringing your energy and insight to today's session. Your engagement has made this more than just a webinar, and it's a stepping stone to a greater achievements. I'm eager to see how you all implement any of these strategies, not only to save, but also significantly prosper in your life. And until we meet again, keep leading with innovation and courage. Thank you so much, everyone.